When you raise private money, not if, when you raise private money, the first one you do, people will keep giving you money. As long as you pay them and the deals work, you will get more and more people and it will change your game. You found somebody, they want to lend you money. What do you do now? They are going to loan you money on a house and you've agreed to terms, and what you need to now do is have a note and a mortgage prepared. Who can prepare them? Lawyers, but also title or escrow companies can do them, and they usually do them cheaper. Let's say your lender doesn't feel comfortable. Like, how do I know what the property is worth? I don't want to borrow money from like any family or friends. Fine. You can borrow from your neighbor. You can borrow from anybody. The easiest way to get into private lending is to get what's called a money partner. Everything is negotiable. Everything. The interest rate is negotiable. The term of the loan is negotiable. Your monthly payments. Is it principal and interest? Is it interest only? Is it interest that accrues and you pay at the end? So the home run slam dunk private money deal, you don't make interest payments until the end, and it's the time period that you want it to be. Hello and welcome to the Real Estate Doctors Podcast, where I'm here to educate, inspire, and entertain you. So today's subject matter is going to be raising private money. And raising private money is, if you're ever going to get to the next level of real estate investing, you have to learn how to raise private money. So for me, I always tell people this unlocks unlimited capital because otherwise you're constrained by banks. So if you're a new real estate investor, you're probably talking to banks and getting pre-approvals, and the bank's telling you they'll give you a loan for 80% or 75% with an interest rate of 7 or 8% these days, and a 30-year mortgage, right? If that's the only way that you are buying property, then you have no idea the potential that you could get into. The next type of loans that people get into is hard money loans. We should really change the name of that. But anyway, hard money loans sounds like it's hard, but really what it is it's expensive. So, typically right now when I record this podcast, a hard money loan is going to be anywhere between 10 to 12% interest. They're usually short-term loans. They give them to people to buy, fix, and flip, or buy, fix, and refinance. And the killer part of hard money loans is, well, there's a couple killer parts, but one is the points. The points are the big deal. So what is a point? A point is 1% of a loan. So if you're going to borrow $100,000, 1 point is 1%. Well, hard money loans right now, people are charging between 4 and 6 points. Now that is a fee, a one-time fee that you pay at closing that's on top of the 12% interest. So if you were going to get a $100,000 loan, you're going to pay 12% monthly interest, and you're going to you're going to pay a one-time fee of $4,000 to $6,000. Now, you may not be a real estate investor, or may be a beginning real estate investor, and you may be saying, this is so expensive, why would anybody do it, et cetera, et cetera. Well, it's not the cost of the capital, it's access to the capital. So if you have a real estate deal and you can make $100,000 and you have no money, you won't make $100,000. If you have a hard money loan and you have to give up 20, 25% of that deal, then you still make $75,000. Let's say you gave up 25%. Now, hard money loans are also good for construction jobs. So you can't go to a regular bank, we'll call conventional loans, and say, hey, I'm buying this house. It has no windows, it has no electric, it has no plumbing, and I want to put $50,000 in it. Can you help me buy it and give me the money to renovate it? Can you do that? You can do that. There are special loans to do that, but they're very hard to get approved for. And if you're a real estate investor and you have done tons and tons and tons of deals, you can do that. But in the beginning, you can't. So everybody ends up at these hard money lenders. Now, I just want to tell you, because you may have just popped on here for a little bit, this is a hard money lender is not private money. This is not what I'm talking about. I'm laying the foundation to explain the differences between conventional, hard money, and private money, and why I like private money better. So if you're going to get a conventional loan, you're going to get a 30-year mortgage. A hard money loan might be 1 year. If you're going to get a conventional loan, you're going to pay between, well, this is for an investment property. Today, you're going to pay 7-8%, and it's going to be monthly principal and interest that you're going to pay over 30 years. On a hard money loan, it's going to be 12%, and you're going to pay 4 to 6 points. So hard money loans are much more expensive. They're shorter in term, but they will give you money for construction too. So if they were used, which right this minute, they are not being used the way that they used to be used, where, hey, if I find a deal and it's $100,000 to buy it and $50,000 to renovate it, but it's worth $200,000, hard money lenders are supposed to give you around 70-75% of the after repair value, the $200,000 that it will be worth in a loan. In that case, they would give you $150,000, and then you would have the money to buy it and renovate it. You would just have to pay closing costs and interest as you go. But now, most hard money lenders in the environment we are in right now they want to see money down, especially if you don't have experience. So they want to see, even if you got the best deal ever, they want to see that you put money in the game. Some of them will tell you they want 20% of the purchase price, but they'll give you 100% of the construction. But again, I don't want to make this about hard money. You can just look up, Google, hard money lenders in any city that you are in the entire United States, and there might be hundreds of them. So it's not, don't think that you can't do a deal, you can always get hard money. So what is private money? Private money is not conventional money from a bank, and it's not hard money. Now, hard money lenders, just so you know, are not banks, but they usually are set up, they could be like just a person that lends money, that's a hard money lender, but they're usually a bit more formalized companies. But they're smaller businesses. Usually they're real estate investors that no longer want to deal with the houses, and they have decided that they're going to lend to other real estate investors because they understand the market and they can make a high interest rate. So private lenders. A private lender is none of these. A private lender could be your mom, your dad, your aunt, your cousin, your neighbor, anybody that breathes. And there's private lenders running around. Like I just watched a movie where they're showing all the digital traces of everybody, like in the Matrix, and so it's everybody. Anybody can be your private money lender. Now, I'm going to go through what that means, what the steps there are in order to borrow that money, how to generally pitch them, why it's good for the lender, and why it's good for you. And I can assure you, it makes amazing sense for the lender and for you. It is a true win-win-win scenario. Win-win. Maybe that's too many wins. So, first off, if you go to a conventional bank, even if you're good and you're a real estate investor and you have experience, they're going to give you a limit. They're going to say, hey, we can loan you up to $10 million. We can give you a line up to this. We can do. So there's always going to be a limit. Hard money lenders, they might even have their own limits. They only have so much money, but they will also give you limits. There is no limit to the amount of money and how frequently you can borrow it when it's private money. So you have unlimited money. Second, this is a great one. You can 100% finance your deals. In conventional loans, you cannot 100% finance a deal. They always want to see you put some money into the deal. In hard money loans, it used to be that if you got a good deal, they would give you 100%. They're not giving you 100%. And I challenge any hard money lender that's going to let you get into a deal with no money to comment down below, and I'll give you a call and send every one of my students to you. But there's no hard money lenders right now. They want you to also put money down. So the advantage of like getting a good deal and going from a bank to a hard money lender doesn't exist. But a private money lender will loan you 100% because you're going to ask them for 100%. And you're going to explain to them that even though, let's say they loaned you $150,000 on a $200,000 house, and let's say you needed the $150,000 for the purchase and renovation, if they loan you that, you still have $50,000 in equity, which covers the lender. So even though they give you 100% financing, they are still covered. So you can get 100% financing, and I do all the time. I won't do any private lending unless somebody's giving me 100%. I don't just mean purchase and renovation. I mean purchase, renovation, closing costs, sometimes interest. So the answer is always no, and the beauty of raising private money is you can ask for whatever you want. And a lot of the private lenders out there, a lot of private lenders there's some that are savvy and have been around for a while and they have their own model, and that's okay. Just ask them what their model is. Hey, I loan 75% of the ARV, whatever it is. But there's a lot of people that have never lent before, or you tell them what your model is. You control the conversation. This is how I do business. I'm a real estate investor, and I fund my deals with other people's money. That's what when I was in the business, that's what I would tell. Somebody say, what do you do? I'm a real estate investor, and I fund my deals with other people's money. Now, why would I say other people's money? I don't say private money. I don't say I fund my deals raising private money, which is what it is, or I love this, and when people start learning about private money, they go PML, right? Well, if I don't know what private money is or PML, I am inclined not to look stupid and ask you what that is. But when I tell you that I'm raising money through other people's money, I want you to ask me, and you want them to ask you. You want them to go, wait a minute, what do you mean other people's money? So I'm jumping ahead though, but that's like the starter move to getting the conversation started about it. So let's talk about some other advantages of raising private money. Another one is you can walk away from a closing. You can buy a house and walk away with money, which in Philadelphia where I grew up, we called that WAM, walking around money, or walking around money. Walking away money or walking around money. It's a funny thing that we used to say back in the day. But in any event, let's say you're buying a house let's use this same example. You're buying a house for $150,000. Well, we'll say you're buying it for $120,000. You're buying it for $120,000. It appraises for $200,000, right? Well, if you have a lender that will give you 75%, that's $150,000. $150,000 minus the $120,000 you're buying it for. You can take $30,000. You can walk away from the deal with $30,000. Now you're going to have some closing costs involved there, but you can generally walk away with $30,000. So I used to say, when I need money, I buy a house. I would just go buy a house that cash flows, that I was very good at getting the deal for, and overfinance it. And when you overfinance it, you get tax-free money. It's not even taxable. And you can take that money. Now, you shouldn't take that money and go get a Ferrari, but you could take that money and go buy another deal. Maybe not with $30,000, but if you did that 3 times, now you have, let's say 4 times. Now you have 4 houses and $120,000. You just go buy another house cash. So you can overfinance deals and walk away with money. That's another one. Everything is negotiable. Everything. So the interest rate is negotiable. The term of the loan is negotiable. The term of the loan is that your monthly payments, is it principal and interest? Is it interest only? Is it interest that accrues and you pay at the end? So the home run slam dunk private money deal is you borrow money, you don't make interest payments until the end, and it's the time period that you want it to be. So let's say I'm borrowing $100,000. The interest rate is, let's say, 10%. That's $10,000 a year. It's a year loan. Well, I pay no payments as I'm doing the construction or whatever it is that I'm doing. And then at the end of the year, I pay $110 when I sell the house, or before if I sell it beforehand. So everything is negotiable. Interest rate, monthly payment, when you make the payment, how you make the payment, whether it's a 5-year loan, 7-year loan, 30-year loan, everything. Here's one for you. You might love this one. You don't need a good credit score. So definitely with a bank, you're going to need a good credit score. And now even with hard money, I just had somebody got denied for having a 653 credit score. They needed 660 in order to get a hard money loan. And the logic here for a lot of these hard money lenders is that the hard money lender wants to know that you can refinance the house and get out so you can get a loan from the bank. Well, guess what? With private money, nobody even asks your credit. That's not on the table. Private money is what we call collateral based. It has nothing to do with you. It has only to do with the property. So that lender is loaning against the property, and if you fail on that property, they can take the property back. So the credit score doesn't matter. Now, will you find some people that say, oh, well, I'm not going to lend unless you have a certain such credit score or you have money in the deal? You will find people that are watching this podcast are going to make comments, are going to be like, oh, that's crazy. I talked to Joe Schmo, and he said I got to put 20% down, and I have to personally guarantee it, and my credit score needs to be whatever. You're right. I'm not saying you're lying. But guess what? There's how many people on this planet? 8 billion. How many you need to give you a loan? 1. So guess what? There's other people out there that will loan on the terms that you want. So what's the other thing? Oh, you don't need and sorry that I'm reading off here, but I get going here, you know? So you don't need good debt to income ratio. So if you've ever gotten a loan from a bank, even if your personal residence, they like you to have a certain debt to income. And if you're a real estate investor, you know, as you buy more property, your debt to income will get worse. And you would think it wouldn't get worse. Here's something for you for the newbies. If you think that when you own one house and you have an 800 credit score, which you might not even have an 800 credit score with one house, but you know, if you own a house and have a high credit score, when you have 30 loans with the bank will love you and you will have proved that you are a good payer and they will give you better interest rates. No, you are a bigger risk. You have 30 times more things that you can go bad on. So you are a bigger risk, and the banks don't use your income. Yes, they use your income. So let's say you got a rental property. They use your rental income's 1,000. They don't use 1,000 as your income in their calculations. They take off 25%. So if your mortgage is 700, now they're going 750 minus 700, you know, and it throws off your debt to income. So debt to income, nobody's talking about it in private lending. Here's another one, very important. I mean, I can't stress how important this is. You do not personally guarantee the loans. So that means if the loan goes sideways and, you know, something goes wrong, you walk away from the deal and you don't personally guarantee it. They can't come after you personally. Now, I'm not saying that's the purpose that you want to get into the deal, but what I learned, you know, I should have learned when I was in my early 20s, I saw a lot of people now my age, you know, in their mid-40s that were doing real estate deals, and they would negotiate tooth and nail to not personally guarantee a loan on a great real estate transaction. And I used to be like, oh man, what do you care? Just say you'll personally guarantee it. But you know what? If that thing goes south, you're not running away from that. So a personal guarantee is a big deal. That means if your business transaction does not work, then they're coming after you personally. Now, in private money, you're not personally guaranteeing it. So there's no personal, it's called non-recourse loans. And it's collateral based. And the last one I have on this is it's fast. So if you have private lenders, like I don't do as many deals anymore. Kind of some of my lenders are mad at me now, but like I used to have 80 private lenders that were ready to do deals with me all the time. All I would do is say, hey, I got a deal, wire it to this title company on Friday, and we would do the mortgage and note, which I'm going to get into the details, the mechanics of the deal. Well, once you have private lenders, they can't wait to loan you money again, and again. And once you have proved yourself one time, trust me, you'll get that money super fast. This is not like the bank needs all your paperwork, it has to go to an underwriter, somebody's going to check it out, has nothing to do with any of that. It's not like a hard money lenders who are faster, who say that they can close her 2 and 3 days, but they can't and they won't. You know, it's a private lender. It's, you know, Sam across the way here from me, who's going to loan me $100,000 at the end of this podcast and doesn't even know. Just kidding. All right, next one. All right, so I talked about conventional hard money. All right, ways of getting private lenders. So everybody's going to say, well, you know, how do I get private? I want private lenders. Well, first off, there are plenty of people that are just private lenders. My goodness, I forgot let me just stop here. I forgot one of the best points, no pun intended, of private lending, which I love. You don't have to pay points. I just talked about hard money, how they charge 4 to 6 points as a fee one time. Well, you don't have to pay points. So, you know, you're saving $4,000 to $6,000 on every single transaction that you do with private money. So I should definitely put that back in the first slide of this. So now, how do you get private lenders? First off, there's plenty of private lenders out there. And if you want a list of private lenders wherever you live, you can just DM me or comment and say, send private lender list. But I need to know what city you live in. And I can send you a list of people that are already private lending. And then you would call them and say, hey, I'm a real estate investor and I'm interested in borrowing money from you. Now those formal lenders, you can handle them two ways. One, they probably have a pretty good sense of how they lend money and what they will lend. Or you could say, hey, I'm borrowing money. I'm doing deals in San Diego. I'm looking for $500,000 deals, and I want to pay this interest rate and this term. And they're going to tell you, okay, no, this is what I'm going to do. Maybe go talk to somebody else. So if you want that list, let me know. Now, the easiest way to get into private lending is to get what's called a money partner. Now, a money partner is the most expensive money you can ever borrow. However, it still benefits you and it gets you in the game. And if you've never done a deal before, it also gets you a name in the game. So let's say you find a real estate deal. Let's use this same one. It's $100,000. You need to put $50,000 in it, and you're going to sell for $250,000. By the way, I don't think that's a good enough margin, but let's say that's a good enough margin for you, right? And you go to, your friend Johnny and you say, hey, Johnny, I got this deal, but I got no money. You want to put up the deal and partner with me? And a lot of times those partnerships are 50-50, and 50-50 is 50% of the deal is much higher interest than if you were to pay even hard money rates, which are like 12% plus the points, like 18% a year. It's much more expensive to partner with somebody. However, there are other benefits. One, you put nothing in the deal. You have no risk at all. And if it works out, obviously, this person will partner with you again. Number two, it gets you in the game. And now you can go to whoever you want to raise money from. And you can say, hey, I did this deal. Here are the numbers. And it's great when you can show people other deals that you did. Here are the numbers. This is how much money we made. I'm looking to borrow money. Now, one of the great advantages also to a money partner is you don't have to make monthly payments. They put up the money. That's part of their gig. If they have an interest cost, usually they cover it. They make profit at the end. One of the things when you borrow money, if you don't structure it, like a good private lending one, if you don't structure it properly, you're going to have to pay interest every month. And when you're doing a project, that can mess you up. All right. So the other thing is family and friends. Now, I have people that tell me all the time, like, I don't want to borrow money from like any family or friends. Fine. You can borrow from your neighbor. You can borrow from anybody. There's tons of places you can meet private lenders. Like if you really want to hustle, go join a country club, go play golf somewhere, talk to people golfing, talk to people at the clubhouse, go to a cigar bar, go to a nice restaurant, a steak restaurant, and sit at the bar, and you just talk to people. People ask you, what do you do? I do real estate deals, and I raise money through other people's money. And then when they ask you, then you start explaining the process. I can tell you that those conversations will lead to at least one person doing a deal. And now, if you get one person doing a deal with you, what do you think they're going to do on the weekend when they're having a barbecue with their friends? Their friends are going to be complaining about the stock market, Bitcoin, this, that, and the other thing, or maybe depends on the market, and then they're going to be like, well, hey, I loan money at 12% interest or 10% or whatever, which is double the bank, and it's fully secure, which I will get into that. But it's going to be fantastic. Once you get one, they will refer you other people. They will come back to you. So you just need to pop the first one. So my favorite way is to create your own lenders. Now, for some of you that are out there, I gave you a couple examples where you can meet random people and, them loan you money. A lot of people have this perception that I don't know anybody with money, right? Which is, first off, crazy because you definitely know people with money. They might not tell you they have money, but they got money. Second off, they don't need money in order to lend you money. So let's say I go and explain all the benefits of lending private money to somebody, and somebody goes to me, well, I just don't have any money. Okay, do you have any equity in your house? Yeah. Well, you can take a home equity line of credit against your house. You can borrow that money and lend it to me. Now obviously the rates are high today. People are going to say, oh, the rates are too high, but if you're borrowing at 8%, you can lend to me at 12 or 15%. I'll go up to 15%. Anybody want to lend me money at 15%? Call me. I'll go up to 15%. Now that person can borrow money that is their equity, really. They can borrow that money at 8%, lend it at 15%, and make a 7% VIG without using any of their own money. That's what banks do. Banks borrow money from the Federal Reserve and lend it out to us at a higher interest rate. It's called arbitrage. Well, they can do it too. So, don't let anybody, don't think because you don't know anybody with money that there aren't people out there with money. And there is a lot of problems when you have a lot of money. Like, a lot of people, have to grind. And when you got a lot of money, you can't leave over $250,000 in a bank account in the United States because it's not insured. And if the bank goes under, you can lose it all. So people with lots of money, they need to put it in investments that are outside the banking system, and real estate is a great one, but also lending to private investors like ourselves is a great one. All right. So what are the formal mechanics of this? Now, I'll try to do this. I won't. When I coach this, I get into like documents and I show the documents, but this is a podcast. So I'm just going to try to do this without going line item by line item, which you don't have to. But what I will tell you is I do not call a lawyer every time I need these legal documents. I paid a lawyer back in the day. I do recommend that your first one, unless you're getting them from somebody that uses them in your state, because they're different in every state. They need to be a little bit modified in every state. Your first one, you should pay a lawyer. So let's say you pay a lawyer $2,000, $2,500 for the documents one time. What documents? You need a note and you need a mortgage, right? In order to do private lending the proper way, right? Now, once you have those documents, you can just copy, paste, and edit them all the times. When I was doing tons of deals, my virtual assistant in the Philippines was giving me, I would say, hey, new loan, 120,000, lender's name's this is the address, this is the interest rate, this is how we're paying the payment, send me the docs. And I would do 5 of them a day. No kidding, 5 of them a day. So it's not like super complicated. And let's talk about the documents, a note and a mortgage. So a note, everybody's seen a note. If you borrowed money on a car, a note basically says, hey, I'm borrowing $200,000 at this interest rate and paying it back with these payments, and the whole loan is due here, right? You've seen them everywhere. Now, a note is what you need that basically tells you what the deal is. A note does not give the lender collateral. So there are a lot of people running around borrowing private money, and what they do is they just get people to sign notes, which aren't, in my opinion, worth the paper they're written on. You need to give the lender, and I advise you to give the lender, a mortgage as well. A mortgage basically mirrors the note, but it's the actual document that gets recorded against the property that you buy in wherever you buy it, the county that you buy it. So when I'm explaining private lending to a lender, I say, well, one of the biggest things I say, first off, do not think, when we go back to like some people are like, oh, I don't know if I want to ask my friends and family to borrow money. You are not asking people to lend you money. You are offering them an opportunity to make more money substantially than they can make otherwise and safer. Now you might be like, well, safer, you don't know. Well, I'm going to go through the mechanics of this. So what I tell a lender is, listen, if I borrow $200,000 from you, you are not wiring me $200,000. You are wiring it to a title company or an escrow company that handles the whole real estate transaction. That money does not get released to anyone unless I buy the property. If I buy the property, at the same time, that money gets released to the seller. What happens is you get a mortgage recorded against the property. So now, let's say it's a $200,000 mortgage. Well, on 123 Main Street, if I go to sell 123 Main Street in 3 days, well, the title company is going to check and say, well, you have a $200,000 mortgage. Please give us the information of the lender so we can get a payoff. And you can't sell the house without paying you off. Now, there are plenty of people running around raising private money that don't give people mortgages, and they just give them notes. Well, if you just have a note and not a mortgage, there's nothing recorded against the property. So I hope this is not you on the other end of this podcast, and then when I sell that property, there's no title company going, hey, you have debt on this property, you have to pay it off. And I don't want to say everybody's nefarious, but some private investors will say, well, that's easier because, they just want me to roll the money, and they take the money and they roll it and they roll it. Well, listen, you don't want to do that. If you're a lender and if you're a borrower, you want it to be on the property, let them get paid back, let them feel the money. Let them feel the money and the interest rate and all the stuff they made. And trust me, they're going to, over the weekend, talk to their wife or their husband and be like, hey, we just got a payoff from blah, 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 blah. And let's do it again, So that's how that goes. So note and mortgage, very important. You send the money to title companies. Sometimes this will come up that these interest rates are higher than usury laws. So let's just say that these are, I don't want to get into the exact detail, but and maybe you don't even know, but in a lot of states, you cannot charge higher interest than it could depend on the state. Some states are 6%, some are 18%. So if you charge higher interest than that, then the loan is in default and it's not a valid loan and you have to give the money back. Anyway, all these loans are loans for businesses. They're business loans that are to LLCs. And so if you're going to borrow money privately, you're going to create an LLC, and you want it that way because the money will be loaned to the LLC. If there was ever an issue, they go after the LLC and not to you. But this avoids all the usury laws. Again, everything is negotiable. It's non-recourse. And I have a note here. You don't need money to lend money. So not only can somebody have equity in their house, they can have a 401k retirement plan, and they can borrow against that, like you can borrow 50% of that. You can have a self-directed IRA plan. You could borrow from your life insurance. So I'm not talking about you, the private real estate investor. I'm talking about different options for lenders. And guys, I'm trying to, encapsulate this as briefly as possible to get you interested in doing this, because this can change your life. I'm telling you, when I started to learn how to raise private money, I went from like, hey, I can do 2 deals a month to I can do 40 deals a month. There's no limit to the amount of deals, that I can do. So I think I have a couple tidbits here, but I think some of these are a little bit more complicated. Some questions people usually will ask is, well, what if I have a lender for $50,000 and a lender for $150,000, and I need $200,000? Well, you can put them together in one note, and they can both be a first mortgage on the property, which I guess I should explain what a first mortgage is. I'll try to do it briefly too. So when you are borrowing money, the person that lends you the money, that puts a lien against the property first, is the first mortgage. The person that puts it second is the second mortgage. Third, now person, bank, company, doesn't matter. Well, I usually have like charts for this, but let's say I borrowed $200,000 from Tom and Mike, $100,000 each, and something went wrong in my deal, and I could only pay. They took the property and they sold it for $100,000. So you would think, most people think that Tom and Mike would split that $100,000 evenly. That's not the case. Whoever was in first position will get all their money first, and whoever's in second position gets their money after that, and so on and so on. So being in first position is very, very important. So you can syndicate lenders. You can put them together so they're both in first position. The other thing is you can make no money down deals with hard money and private money, or conventional money and private money. So let's say you go to conventional bank says, hey, I can give you a loan for 80%. Well, you can raise private money for the 20%. Now that would be in second position to the bank, but you can do it. You can do the same thing with hard money. So you can do no money down deals with private money. You can basically do whatever you want with private money. Let me see here. I just talked about the mortgages. All right, let me just give you a couple things when you're pitching the private money. So first off, again, you are not asking people to lend you money. You are offering them an opportunity. So how much do you pay people? Well, right now, interest rates are kind of high, so people can make, especially people with money, can make 5% on their money just in the bank, right? So you're not going to get anybody who's going to loan you 5% or 6% or anything like that. The reason hard money lenders are charging 10 to 12% is that's kind of the market. So, like I told you, you might pay 10%. I'll pay even 15%. I wouldn't recommend that unless you're really good and know what the deals are. But again, it's not the cost of money, it's the access to money. So your pitch to somebody is like, did you know that you can make double the money you can in the bank by lending money to me on a real estate project, and it's safer than you putting money in the bank? Well, hold on. What do you mean double? Well, I don't know. Are you making 5% interest in the bank? No, my bank only pays 3%. Well, you can make triple. I'll pay you 10%. I'll tell you, and there's two sides of this. Like, how do you come up with these interest rates, right? Well, I usually tell them my rates vary between 8 and 15% depending on the project, right? So, well, I want to make 15%. Okay, well, I'll let you know what project that is. Now, how is it safer? Well, when you loan money to me, you don't send it to me, or you send it to a title company. Title company puts a mortgage on the property, and if you put money in the bank, you send the money to the bank, and then the bank sends out 90% of that money everywhere else. Your money is not in the bank, and they're paying you a lower interest rate. So it's definitely safer for you to lend the money to me and have a mortgage on a property than it is for you to put it in the bank. Now, you want them to ask questions. Now, let's go to the, like, what are the questions that people are really worried about? What if I don't pay, right? So if I don't pay, let's say you're the borrower and you don't pay the lender. Now, one thing I always tell people too is you want to go through, and guys, this is not a list of everything I can teach you on raising private money. It's not possible. I would say that, for some of my students, if they're fast, in about 3 hours of learning and some role playing, which I love to do the role playing, you can raise private money. My fastest students, they did 3 sessions, role playing. I went to bed. I woke up the next morning. Shout out to my Sacramento guys. I went to bed the next morning, and they had raised money, 100% financing for a deal with the interest to be paid at the end, which they have now. This is, before they have sold that property and moved on to now that they have too much money. Literally, they're telling me, listen, we need more deals. Can you help us get deals? Because, we got tons of money. So once you do raise private money, it will open up the floodgates for you. I'm telling you. So a couple things here. You want these people to ask you questions. One of the questions they're going to ask is, what if you don't pay me? Well, the answer is, well, then you can have the house. Well, a lender doesn't like that answer. That lender doesn't want the house. But once you explain how good of a deal you got, like, hey, I'm into this deal for $150,000 and it's worth $200,000. You can take the house back and you make $50,000 and more interest than you would otherwise. So a lot of lenders don't want a house. They don't know what to do with the house. They don't know how to get the house. Like, how do they get the house? So how does it go from me owning the house to them owning the house? If you don't pay them, and I don't want to get into like super technical stuff, the way that banks get the house is they foreclose on you. So if you tell a lender like, hey, well, you can just foreclose on me, the lender's going to be like, well, I don't know how to foreclose. And you go, well, you can get a lawyer, pay them $5,000 to $8,000, and wait 10 months in order to take the property back, and then you can sell it. This is that's not a good deal for them. So what you do is you give them a deed in lieu of foreclosure, which is basically a fancy way for saying you give them the title. You sign the title over to them. You have a deal in your agreement that says that if you miss 3 payments, that they can take the title and just put the title in their name. This is no different than what banks do with your car loan. When you get a car loan, you have a note for the car loan, but a lot of people are like, I didn't do a mortgage for that. It's not collateralized. Yeah, it is. They hold the title. You don't get the title until you pay them off. So this is the same kind of thing. And I'm going through this as fast as possible. If you want more details, let me know offline. But, you want to give them a deed in lieu of foreclosure. So now I go to Mr. Lender. The minute I don't pay you, I try to make it 3 months because 3 months is, I think, fair. Boom, you can take the property and go sell it to somebody else. And you can make a profit. You can make bigger money. So that's one thing. So let me see a couple other things. Yeah, you need to educate these lenders. What's the worst thing that could happen? Which is you don't pay. I did not talk, and in order to kind of mitigate some of this, I didn't talk about construction loans. So with hard money, you can get loans and you can do construction on a house that's not habitable. You can also do that with private lending, and your private lenders, this is me in a super brief way saying, the private lender, let's say the house is $100,000 and the rehab's $50,000. The private lender will send you $100,000 to buy it, and then they send you the $50,000 as you do the construction. You know, some of these private lenders will just send you the $50,000 at closing, which I don't recommend if I was advising them, but they will. And some of them will ask for you to do draws. But there are tons of ways to protect your lender. So I'm going to go through a couple things. These are the benefit of the lender, and you want to explain this to the lender so that the lender feels comfortable with the deal. You can put in your agreements that there's assignment of rents. What that means, if I own a property, it's rented out, and I stop paying the lender can knock on the door and say, hey, Mr. Tenant, you're not paying him anymore, you're paying me, here's the document. So they will get to collect the rents. You can put a confession of judgment. Now, I have two sets of docs. I have docs that are good for the lender and docs that are good for the borrower. So when I'm lending, I put all these things in here. So confession of judgment means I don't have to go to court to get a judgment against you. I automatically have that judgment. You can put a default interest rate. That always gives incentive for the borrower to pay. So the interest rate's 12, but if you're late, the interest rate can automatically go to 18 or 19% or whatever. The deed in lieu of foreclosure, which we talked about, it's like basically giving them the title. Explain the foreclosure process with the deed in lieu is instantaneous. Your lender, here's a question that I didn't get in here. Your lender can also get title insurance on the property. So if something was wrong with the title, they get insurance too. Also, what about your lender? Let's say your lender doesn't feel comfortable. Like, how do I know what the property is worth? Well, how you know what the property is worth is one, I usually say, because it doesn't cost me any money, is, well, I can run you comparable sales in the neighborhood, and you can see all the properties that are selling that are 3-bed, 1-bath, and same square footage, and get comfortable like that. Some lenders are going to say, no, I want to get an appraisal. So you get an appraisal. And if you want to make your lender comfortable, you say, hey, we'll get an appraisal to make you feel comfortable that it is true that I'm $150,000 in this house and it's worth $200,000. I'm not going over how to structure a deal when you do have construction involved, but you can definitely do that. And I think that's about. Let me just be clear that let me just close up with the process. So let's say you found somebody, they want to lend you money. What do you do now? So they are going to loan you money on a house, and you've agreed to terms. And what you need to now do is have a note and a mortgage prepared. Who can prepare them? Lawyers, but also title or escrow companies can do them, and they usually do them cheaper. So you could call the title or escrow company that you're closing at and saying, hey, I have a private lender, and these are the terms of the note. Can you prepare it? They're going to charge you, but they can prepare it. The lender could also prepare it, like very advanced lenders, like I'm going to prepare my own. I'm not going to let you prepare mine, but most people will actually let you prepare them. So you prepare the note and the mortgage. The lender doesn't need to sign a note and mortgage, only you do, because you're the one that's borrowing the money and owes the money, and you sign them at closing. Now we're doing most closings virtually with a notary at the closing. So when you go to close the money, so let's say the deal's closing, you tell the lender, hey, here's the docs. You agree with the documents? Yes, I do. All right, send them to the title company. All right, we're going to close on Friday. Make sure you wire. They wire the money to the title company. You close. You sign to buy it. You sign the note and the mortgage. The title company gives all the copy of the note and the mortgage to the lender and records the mortgage in the county, and now the deal's done. You own the property. They own the debt. It's recorded. Everything's good to go. So that's kind of how it goes in a nutshell. So raising private money, there's a lot of elements to it. And it's definitely more in depth than this. But what I will tell you is when you raise private money, not if, when you raise private money, the first one you do, there will be 1, 2, 3, there'll be unlimited. People will keep giving you money. As long as you pay them and the deals work, you will get more and more people, and it will change your game. If you're a real estate investor and you're only working with conventional money, hard money, lines of credit, you need to get into raising private money. So thank you, guys. Sorry that this is a long-winded subject, but it's a very important subject. I talk about it all the time, and it can be a game changer for you to do deals with no money out of your pocket. Have the best day of your life.